Good morning and welcome to the first session of the last day of our series of three-day series of investment trust presentations. This session is on Midwine International. We are joined by Alex Illingworth, one of a triumvirate who've managed the trust since 2014. Alex, Simon Edelson and Rosanna Burcheri have worked together since 2011, and the team make use of 8 to 10 long-term themes within the portfolio at any one time, aiming to anticipate how these themes will evolve over the next 3 to 5 years to inform their stock selection. The team aim to provide investors with much of the upside to equity markets, but also try to protect capital on a relative basis when markets fall. This characteristic was evident during 2020, and the result over the past 12 months, they've been amongst the top performers in NAV terms in the global sector. Before I hand over to Alex, a small amount of housekeeping. We'll have about 30 minutes for the formal presentations, with 15 minutes available for questions. Your microphones are muted, and if you would like to ask questions, then use the box at the bottom right-hand corner of your screen. If you type in the questions, I will try and address them to Alex. We've got quite a few people on the call, so I'm sorry if we don't answer all the questions, but we will try and answer the questions and send them back to you if we don't cover them during the session. So without further ado, over to Alex. Thank you.
Billy, thanks. Good morning to you all. It's a good day to be presenting. We've just released our half-year report, so for those of you who fancy some weekend reading, you can download that from our website at a later stage. For the sake of good order, you see the important notice here, and just to talk a little bit about the objective. Essentially, what we try to do is to keep up in bull phases of the market, but rather than chase markets, we try and build in as many buffers as we can for more difficult periods. Over the next 30 minutes, I hope what you'll get a sense of is that this is a fund, it's a core equity holding, really, an equity holding hopefully that can get you through the cycle. What's differentiated really is in the goal, and the goal is strong risk-adjusted returns. Yes, strong returns, but the risk adjustment is particularly important part of what we're trying to deliver. And what I mean by that is we're not looking to be in the leading pack of competitors in strong bull phases, or at times like this where there is a very cyclical bias to markets. We're much more focused on providing growth in real wealth through the economic cycle. We absolutely respect the benchmark, but we think it's helpful if you approach fund management with a private client view, actually. If you approach fund management with a focus on growing people's real wealth. And if you start from that premise, it's completely natural, therefore, that you would try and build in some capital preservation buffers for more difficult market conditions. And as such, it comes very naturally to us when we think about risk, not to think of it as a relative term, but as absolute loss of capital. And therefore, the risk analysis is thorough and fully embedded within the process. And its aim is to understand the materiality of every data point that we think is relevant to the investment thesis, whether that be a traditional financial one or one that is an ESG issue. In order to put this product together, you need diversity, and you need to be able to deliver a portfolio which demonstrates lower risk versus the benchmark. And this we achieve in brief by sticking to quality companies in our chosen areas, but stay broad in our exposure. So turning specifically to the slide in front of you, if you look on the top left under the heading real wealth growth, you can see that hopefully we can demonstrate that we have delivered substantial alpha, and you can see in the chart above that we have delivered it in a consistent manner. And you can also see that most of the alpha generation, the outperformance versus the index, has come through our own stock selection. You can see in the middle under the title lower volatility that we have actually done what we set out to do, in that we have a portfolio that is lower risk than the benchmark, lower volatility than the benchmark. Beta have been a measure of volatility. And we have outperformed significantly when markets have fallen. That 73% number that you see in the middle there represents the outperformance in months when the market has fallen. And for those of you who know us well, we've been running this portfolio since 2014. There's also a unit trust, which we've been running since 2011. And this outperformance number in down periods is just as strong for the unit trust as it is for this investment trust. And that type of product does require diversity, and it does require us to run a portfolio we think is relatively diverse, 60, 65 stocks being about the normal set of numbers that we think is relevant for us. And as a result of our quality criteria that we're looking for to deliver that consistent performance for you, the client, and our emphasis on analysing all risks, whether it be financial or externality risks, we end up with very strong ESG metrics. So just to give you an example, on the right-hand side, you can see that the carbon intensity of the portfolio is, almost half that of the index. So this is how we want our money to be managed. It's also who we want to manage our money with. Being three people allows us to make timely, make informed decisions. Probably worth pointing out that none of us started running money this century. But really the key here is same team, same philosophy, same process, same place for very nearly 10 years. We joined in May of 2011. And that's a very powerful bond in order to allow the process of fund management to work efficiently. And as a result of this, we're all significantly invested in the strategy. And for those of you who know us well, Simon, in particular, owns a significant chunk of this investment trust. So moving on to the next slide, this is really trying to put a little bit more flavour on this idea that it does what it says on the tin, a proof of concept. And if you look at the chart on the right-hand side, what we have done here is we have plotted risk as measured by standard deviation against capital growth in the value of your product. And you can see that compared to peers, we have grown capital, we have grown the fund by a greater amount than most people, and also done it with lower risk. And the reason I show this is because exactly what we are trying to deliver you. And much of this success has come from our ability to be able, our valuation discipline and our analysis not only of the free cash flows that are on offer in the market, but also the barriers to entry, or more particularly the durability of the barriers to entry. But I did want to make a point here that we do understand that there are times for growth and there are times for value. And as you'll see later, we have a tool to assess both of those particular market environments. And we think it's absolutely critical that you don't have one way of valuing stocks if you are going to get clients through the cycle and do it with lower volatility. We need to be valuation sensitive, and we need this toolkit to adapt to market conditions if and when is required. The next slide just talks briefly about the process. And the idea is not to start with the index, but to start by thinking like a business owner, sit around a table, try and work out where we would like to allocate capital, our own capital today, in order to deliver consistent growth in cash flows in the future. We're looking for these areas of secular growth where consistent growth can be garnered by a set of companies because they are exposed to a particular area of the world or a particular market, which is growing and is not overly dependent on the vagaries of the economic cycle or things that are outside their control, such as the oil price or FX. And what we do is we read quite a lot of books and journals, and we try and write industry roadmaps around where we think particular industries are going, to try and find some sustainable business models, to try and find companies that can look after themselves and prosper because of the growth that they are pointing towards and the sustainability of their product line. And then it's only at the end that the valuation comes, and that, as you can see, and I've alluded to earlier, has two different elements to it. One is a cash flow model where what we're trying to do is ascertain what's priced into the company share price today. But the other is a real assessment of value, and we can talk more in Q&A if you like about this, but our understanding of value is something related to the balance sheet. And so this is trying to rebuild the balance sheet to see if there are companies which are trading below the cost of reproducing those businesses. And that's particularly important at times like this, where we're seeing a turn in the market dynamic. And we think risk is managed, all the way through the process. We're buying good industries, we're buying good companies with strong balance sheets within those good industries. And then we're balancing the portfolio at the portfolio construction stage to make sure that it does what it says on the tin. A quick word on responsible investment. I've used the word sustainability already. Taking you right back to the beginning, we are trying to grow your real wealth in a sustainable, consistent manner. And of course, if you're going to do that, it's completely natural that you've got to have some rules in place to avoid certain areas of the market which are inconsistent, and also combine that with some strong principles around governance. So what we actually do is we specifically avoid certain areas, as you can see on the slide there. We avoid markets or sectors which are poorly governed or where externality risk is high. These are difficult things to evaluate, and there are plenty of other ways for us to grow your real wealth without being involved. Excuse me. So to give you an example, we just don't do Russia, where we feel that the governance is not good enough. We don't do tobacco. Beyond that, we're seeking these compounding of returns within sustainable growth areas, and that's led us to themes such as, you'll see later, one which we call low carbon world. These are stocks which are benefiting from a concerted move towards Paris alignment, to a reduction in carbon dioxide emissions, greenhouse gases in general, globally. So we're drawn to these areas, and that certainly feeds in to the MSCI ESG score that you saw earlier. But remember, the themes are just a direction for us. What really matters is the valuation. And to give you a more recent example, there are certain areas of the wind turbine, of the wind farm quoted sector that we think are too expensive, and we have been selling because the valuation is telling us to do so. Beyond that, and integrated into the next stage, is just an analysis of the materiality of certain bits of data. And without becoming too bogged down in this chart, you can just see at the bottom some of the things that we think are important. And our job is to discuss the materiality of these issues within the context of the investment thesis. And that allows us, we think, to be better analysts and to make a longer-term, better decision about the investment case. In order to do that, you have to employ judgment, and a lot of the judgment does come from experience, and you also have to understand the whole investment case. And of course, as a result, we think this is hugely superior to using scoring systems, which naturally are somewhat backward looking, historic, and a blunter instrument. But to be totally clear here, we're not looking to change the world, nor do we presume to have an ethical code that all would follow. But our aim is to invest in companies which prosper, but without damaging society or the environment. So we think that we've been able to meet our clients' objectives. Certainly, healthy returns helped by equity markets doing pretty well over recent years. I wanted to just put this chart up just to show that both products that we run have done what we had hoped, but also to draw out in particular 2018, where the market fell, and you can see consistent outperformance. And that's really because I want to show you that we demonstrate our ability to outperform in difficult market environments. If I was able to show you 2011 for the unit trust, again, it's the same situation. If we split out the quarters, as Billy mentioned at the beginning, if you saw Q1 2020, significant outperformance in a down market. Hopefully, this is proving the point that we're trying to deliver. And of course, this consistency has enabled us to develop a product which has grown very nicely. We've been able to issue plenty of stock, as you can see at the bottom there, pretty much on a consistent basis. That's been accelerating more recently. We've been able to maintain a 2% premium to NAV over really quite a long period of time now. We've been able to grow the dividend. Our cost structure is very reasonable, and we've done this without using a huge amount of gearing, or not using a huge amount of gearing of late. Gearing is not a very large part of the investment thesis here, but it has added to performance over the years. Of course, what really matters are the roadmap work, the themes that drop out of the roadmap work, and the stocks that we then go and look at and analyze as a result of that roadmap that's done previously throughout the team. And so this is really the most exciting chart, just to look at some of the stocks which are driving the performance. And just to take the top one there, to talk about automation. I mean, the fascinating thing about automation, I mean, this involves vision, robots, industrial warehouses being more automated. Indeed, this company, Daifuku, is the leading player globally in automated warehouses. And of course, the demand for automated warehouses is so much greater today as a result of e-commerce ballooning over the last few years, in particular last year. But almost all the best companies here sit in Japan, and it's a classic example that if you invest with this idea, invest looking for these pockets, these clusters of secular growth globally, you've got to do it on a global basis. And so we've had a whole raft of stocks in Japan which have done us very well, as you can see, over a number of years, actually, not just last year. But with supply chains tested throughout COVID, political pressure versus China, there's been ever greater need for robotics. They provide greater efficiency, they drive processes at a much lower cost, and of course they allow the factory to produce lower emissions as a result of their work practices. So that's one theme which has been very relevant for a number of years and continues, and I would say has increased in relevance as a result of COVID. And maybe that's a point worth making. The whole point of the roadmap work is to try and analyze trends that are going to be in place for a long period of time. And what COVID has done is it's done in many areas, it's been an accelerant for change. And as a result, the trends that we were already invested in have accelerated during 2020. And if I tot up these 9 themes, I think 6 of them have been beneficiaries of the changes that we've seen as a result of the pandemic. So that's a great hit rate, but I think it's testament to the process, testament to the way that we run money. If you are looking for these trends, you don't quite know when the growth acceleration will come, but you do know that it will come. As long as you're not paying too much for the share price at any one time, this should allow you to grow real wealth over a period of time. But just to look at another sector, just because obviously it's the most pertinent, it's this sector on the left hand, or this theme on the left hand side called scientific equipment. And the poster child I use here is Thermo Fisher. So before I get into it, of course, these are the companies that do all the testing for COVID-19. And of course, they've had a bumper year last year, and they will have another fantastic year this year. But previous to that, the reason that we were invested in these companies was that the sequencing of the human genome, and in particular, the cost reduction of the sequencing of the human genome, had got to such an extent that there was a proliferation in drug discovery. And at every level of discovering a drug all the way through to production, there has to be an enormous amount of testing devices. And these companies were playing into that. In addition, at the same time, we were seeing greater demand for food testing, for water testing, air testing, general environmental testing. And so these companies were on a very strong growth path. So what's fascinating about COVID is we were previously testing compounds, and now we're testing people. And these are the companies that provide the PCR test, and they also provide the lateral flow tests. And what's most interesting in the debate, just to give you a flavor of what's going on in the team at the moment, is the debate about what's next. So without getting too much into the detail, the PCR test, as you probably know, is considered the gold standard. It's a molecular test. The lateral flow test is an antigen test. Its efficiency is much better. Its accuracy is much better than it used to be, but it's never going to be as good as the PCR test. And at the moment, certainly in the UK, we've got huge support for both. And the debate in the market, and these companies have been sold off recently, because people are slightly concerned that the future post 2021 will not involve so much testing as a result of the vaccine and our ability to get back to work. So the analysis within the team is, what do we think is the world in 2022 going to look like? And will it involve just as much PCR or more lateral flow tests? And whilst it's very difficult to know, we are actually strong believers in the durability of lateral flow tests. We just think that what's changed is that we were previously testing to find people who were positive so that we could treat them or quarantine them. And now what we're doing is we're testing people to find negatives so that you and I can go out and enjoy our normal life. And that really plays into the role of the lateral flow test. So we've been skewing the portfolio towards the lateral flow test, and it's great sitting in the UK because this country really does have all of the capacity. It has all of the testing capacity, far greater than almost any other country, and so certainly should have the best data to make the right decisions. So that just gives you a flavour of the narrowness of each theme. But what I also wanted to point out in this slide is the diversity of having 9 themes allows us to build in that balance that I talked about right at the beginning to make sure that we can deliver that risk-adjusted experience for you. We're pretty pleased that when we look at the contribution from particular stocks or from particular sectors, that it's come from a wide variety of different areas. Again, it tells us that what we think we're doing, we are actually delivering. We're showing that the performance is coming from a variety of different areas, which hopefully will allow us to continue to sort of deliver some consistency, and that we can do what we say we do, which is get people through the cycle. So hopefully, you'll get some comfort that the trust has done what it set out to do, and that we have the tools to continue to do that. We move money around the globe as we judge value for money. We have pretty flat structure in terms of the unit size, as you can see the positions on the right hand side. And that comes back a little bit to our desire to grow people's real wealth. You know, we think 2% of your money is enough to make good money if it works, but not to lose too much if the investment thesis doesn't play out. So we look to try to get to a sort of unit size of around 2%. We hope that you can see that we offer some credibility, some track record. We've got, you know, quality bias, limited leverage, but yes, a quality bias, but an ability to assess both growth and value. And that should allow us to perform reasonably well through the cycle. And you can see we're pretty diverse on a global basis. Japan's quite a large position for us as a result of the automation stocks, and well diversified at a sector level. So we think these are most of the attributes that one needs for a core equity holding. So the last thing I was just going to talk about was, you know, a little bit of you know, where we are today. I mean, obviously we're in a very rotational market at the moment, which is very interesting. I think that bond yields going up, and certainly the speed of bond yields going up, means that one needs to have a slightly greater discipline around valuation. I don't want to go too far away from the fact that the lesson of the last 12 months is that our companies can cope pretty well, thank you very much, with most of what the world can throw at them. And when we look at the in each of the individual companies and we hear what they've got to report, we see lots of innovation, lots of value creation. And so we like the look of the portfolio. We think that it's a good place to continue to make money. We could see bond yields rise further from here, and clearly there will be some inflationary impacts. We're personally not huge believers in rampant inflation any time, and certainly not any time soon. And unless we get that, we still think that equities offer, you know, certainly a good solid platform to deliver this growth in real wealth that we set out to do. So Billy, I'll hand it back to you.
Thank you, Alex. Very interesting. We've got a raft of questions, and I'll try and do my best. Maybe just go back to page 16. Sorry. There we go. Maybe you just talk about your holding period, and you know, your sell discipline. How long do you hold stocks? I mean, obviously I'm giving you the answer because it's on that page, but you didn't refer to it specifically, I don't think, in the presentation.
Well, there are a number of answers there. So the first thing is you can see that quite a lot of the stocks have been held for a very long period of time. The other thing I think that's worth pointing out is if you look at the chart on the right-hand side, there's quite a markup in activity or turnover, and that will correspond with March of 2020 or the early part of 2020. So there are many very successful people who advocate low turnover. We just feel that our job is to try and get people through a cycle, and when the facts change, and they really did in March, then you need to be relatively active, and you can see us being active to mitigate the downside. And I think we got evidence that worked. And I'll give you another example. As we think about our theme around low carbon world, we know that the only way that we're going to move to an electrified world is through greater use of copper. And we actually think that copper mining companies are a key part. We know that they are a key part of getting there. Now, for many, a mining company, any mining company, would not pass their ESG criteria. But for us, we feel that this is an environment where these copper companies can really be enablers for the transformation to a low carbon world. And whilst we're very keen to avoid those that have very bad governance issues, most of them are moving in the right direction. And as a result, we have bought positions in Freeport-McMoRan, we've bought positions in Grupo Mexico, both of which have big exposures to copper. And we wouldn't have done that a year ago. So that is the reason for the activity and the need to change. I think it's particularly important for the need to be able to slant the portfolio at a period of time like this, where cyclicals, banks, oils are moving very, very quickly.
Thank you, Alex. On a sort of related topic to the miners, one question is that every investment you make is directly or indirectly relying on oil and gas. I suppose a lot of us are. But given that, I find the question is, why do you specifically seek to exclude oil and gas from the fund? Noting that there's been quite a run up in the sector recently, and that they'll be generating huge amounts of cash for years to come. So maybe you could expand on your sort of position on that.
Well, the easiest, most basic answer is we're looking for areas of secular growth, and we think that if we can invest in those areas, we will grow your real wealth at 8% a year, so to speak, and that should be good enough. And the truth around the oil and gas industry is that it's not in secular growth anymore. I mean, I don't want to be rude about the area, but clearly we are trying to use less of it, and we think that analyzing companies with externalities that they have is much more difficult than analyzing a company like Thermo Fisher. I really don't know what carbon tax is going to be levered in the future. I don't know how much it's going to hit BP. I don't know how much of the petrol station network is going to be, or the refining network is going to be underutilized in the future. So I would rather use my analytical skills to focus on other more predictable areas.
Great. And actually, the first question we had was, what exactly do you mean by real wealth?
Well, I really mean trying to grow your wealth at 8% a year. But I don't want in an environment like this to be held to that. But I want you to understand that that's the way we think about it. So when we're taking money out of the bank, so to speak, from our cash pile, to invest in a particular stock, we are asking ourselves whether we think that we're going to make a return which is in excess of 8%. And even more than that, if you go into our model where we do our discounting, we use an 8% after tax number. And so that's the metric that I'm particularly looking at. If you can't make 8% in equities, when bond yields are 2.5, if they get to that stage, you might be more happy with a lower risk 2.5% return than a higher risk 8% return. That's our way of thinking.
But also, I suppose real wealth implies that your the 8% return is going to be ahead of inflation, whatever the inflation might be, which links to the next question.
I think at 8% with a 2% inflation, you double your money in 10 years. Is that right? I think that's the maths.
Well, how will you manage the portfolio if or when inflation takes off over the next 5 years?
Sorry, could you repeat that?
Oh, sorry. How will you manage the portfolio if and when inflation takes off over the next 5 years?
Well, if inflation is 6%, and interest rates are commensurate with that to try and bring down inflation, that's probably bad for risk assets. So you'd see us you'd have no leverage, you'd have higher cash, and you have companies which are not overly dependent on economic growth. So you probably end up going back to the tech names.
All roads lead to them. We were joking before the presentation started that you were about the only team in the world who've ever taken an investment trust off Baillie Gifford, since they seem to be taking over everyone else's investment trusts. But what are the main changes that the trust has made since Midwine was part of Baillie Gifford, or was in the Baillie Gifford stable? And obviously, just to be absolutely clear, Alex and the team weren't part of Baillie Gifford. They pitched for the mandate.
The main premise that the board came to us is that we want this fund to have an independent future. And remember, this was £70 million fund when it came over in 2014. And our retort to that was, well, you needed a lower risk product. Now, of course, that's probably the wrong thing, given what Baillie Gifford have done over the intermediary 5 years. But you need to have a lower risk, more diverse, more balanced product, one that investors can trust as their core part of their equity holding to get them through the cycle. That's what the board wanted, and that's what we were able to provide. So, greater attention to valuation, much lower risk, greater diversification, and slightly larger cap.
Great, thank you. If there've been a few questions of the sort of the benefits of holding the Midwine over your Oink, and an observation that the investment trust seems to perform better than the Oink. What are the sort of main differences between Midwine and the Oink?
The differences are that Midwine obviously can and has employed a little bit of leverage. That's the first thing. The second is that it has a slightly longer list of stocks, and it has a slightly longer term view of the opportunity. So there are some slightly harder to value stocks in there, which not just in the technology area, but they've mostly been in technology, which is one of the reasons why it's performed better. And the other difference is, of course, one trades at a premium but has a lower management fee attached to it. One obviously trades at a single price but comes with a higher management fee.
Thank you. This is a potentially interesting question. How can a team with a global remit ever gain the insight and expertise to pick stocks as against a regional or country-focused sort of trust or team? For example, how can you better pick Japanese companies than a team based in Japan, purely focused on that market?
Well, I think we've demonstrated that we are able to do that. I mean, it's hard to show that when people have 40 people doing one thing, that 3 people can do just as good a job or potentially a better job. But these are the reasons why we think we can do a better job. First of all, we do have quite a lot of experience between the team. You've seen how long we've all been at it. We've never actually managed any funds other than global funds. The next thing to say is that there is a benefit of looking globally, and that allows you to spot opportunities and take that theme, so to speak, around the world. Automation is a classic example. And the last thing is that your global aspect and allows and combined with the desire to just focus on feeding the benchmark but growing that real wealth 8% a year means that you only focus on a certain sphere of the market. So you get perfectly relaxed about missing the latest shiny thing. I talked at the beginning that we're not looking to chase markets. We get used to missing things. That simply doesn't matter. As long as we know our stocks well and we think that they can generate the returns that we're asking of them, we will do a good job for clients. And you can worry much less about the rest of the world.
Great. Can you talk a bit about Artemis and the culture of the business, and the partnership with AMG, which I think is, I'm not quite sure what that is, but.
Yeah, so briefly, AMG, Affiliated Managers Group out of America, they own 60% of it. They take a share of revenue, and I mentioned that means that we run our own business, and how the profits get shared out is an Artemis issue, not an AMG issue. The partnership obviously brings everybody together much more because we're very much invested in how the partnership profitability looks. And hopefully it promotes a culture which allows us to be relatively collaborative with each other. The business has changed quite a lot since over the 10 years. In particular, the thing that's made a massive difference to us is that Cormac Weldon has come with a very large team from Threadneedle to run a US product, which many of you will be familiar with. It's been successful. But that comes with a whole bank of analysts as well, which are a huge asset base for us, not just to share meetings, but to share ideas with.
Great, thank you. You talked, can you expand on how you identify the stages of a cycle and how you would, or where you'd locate the trust currently in the cycle?
So the themes have to drive the stock decisions, and that's where the majority of our work goes on. But obviously, one has to understand that, for example, at the moment, bond yields are driving markets. So we're at a period of time where a reflation trade is possible and certainly being reflected within some share prices. And just to be absolutely clear, reflation will not be a theme for us. The theme is healthcare costs, the need to reduce the cost of the provision of healthcare, or automation, as I mentioned earlier. But we do understand that in a reflationary environment, that those companies that have got real asset value as derived from the balance sheet could actually do really quite well, and that asset value could be unlocked. So what's particularly important at the moment is that the balance sheet work, which has been playing second fiddle to the cash flow work over the last decade, is super important to our ability to get through this period. So if we can find companies that are trading below the cost of reproducing the business, and many banks are, especially in the UK where they're trading below book value, then we can see how they could do really quite well over the next short period of time, and we'll see whether the yield curve continues to back up, which is particularly important for banks. So how do we determine where we are in the economic cycle? I think it always depends on what the different factors are, but certainly we're in a reflationary environment now, and how that pans out is very important in terms of the shape of the portfolio. The stocks and the themes will stay the same, but we will dial them up and down depending on how we view the macro environment.
Thank you. There's a question on the board and how independent they are. And I'm not. The question is, the board can't, or it starts with a statement: the board can't be independent if they own independent stakes in the fund. Are there any non-execs who do not hold stock? And I'm not sure that's 100% right, because in some ways, if the board own stakes in the fund, that's a good thing. But because they employ you, if they don't think that you're doing a good job, then they'll move elsewhere. As was the case with when they put the mandate up to take it away from Baillie Gifford. But maybe you could just talk about the dynamics of the board and maybe answer the question of are there any non-execs who don't hold stock? But also maybe try and explain why there's a benefit to them owning stock.
So the short answer is there are no directors who don't own stock. We welcome them having stock. We declare to them how much we own personally, and obviously they like to see that, so that we're all in the same boat. The Scott family, which were the big shareholders when we took it over from Baillie Gifford, have not really sold but been diluted out, and with the recent change in chairman from Malcolm Scott, obviously there is potentially less influence on the board. So it's certainly becoming a more diverse board. There was a family element which is much less today. And for those of you who know Russell Napier, he is now our chairman, and he's certainly a robust intellect and gives us a particularly hard time on various issues. And for those of you who are familiar with his work, he is a big believer in inflation, where we are less believers. So without getting in too much of the details, that certainly provides a lively debate at board meetings. But they all own shares. I think Russell Napier has actually bought more recently, which shows their support for us. And I think Simon has bought more recently as well, again showing his commitment to this trust. I mean, I haven't quite looked, but he owns between 15 and 20 million pounds worth of the trust.
We've got one more minute, but just quickly then, you don't own Russia, but you do own stocks in China. So can you just explain? Obviously China have a questionable human rights record, not least in Tibet. Does that factor into your investment?
Well, maybe I should be quite clear about what I specifically meant about corporate governance. I mean, the problem with Russia is they might nick your money. There hasn't really been an instance of that. in China yet. Going back to Russia, we were all invested in UCOS at the time, and we have felt that that kind of thing could easily still happen. The human rights in Tibet, is something that one doesn't want to get involved in. But I do have to judge the materiality of the investment thesis with some of the governance factors. What I will tell you is that we do like China. We do like the growth opportunity that exists there. We don't have a vast amount of money there, but we are increasingly concerned that the top-down governance from the government themselves is getting worse. And when the government cancelled the Ant Financial IPO in Hong Kong, we were holders of Alibaba stock, and we sold our stock at that moment. We felt that was the straw that broke the camel's back. It's very difficult to explain where this line in the sand is, but I want everyone to understand that we take these things seriously, and there is evidence that we are using our judgment and hopefully experience to judge that the government control is getting too great to allow our analysis to be as accurate as we would like going forward, and we've taken action.
Fantastic. Well, I think we've pretty well answered all the questions, which is unusual. So well done, Alex, for getting through them nice and quick. We are over time now, but thank you so much, Alex, and thank you all for diving in to listen to him. The next session is at 10 o'clock with Peter Hewitt, he's the manager of BMO Managed Portfolio. So thank you so much, Alex, once again, and hopefully see you all soon. Thanks.